Good morning. My name's Richard Green. I'm director of the USC Lusk Center for Real Estate. And it's my pleasure to welcome you today to the 2023 edition of the Casden Multifamily Forecast. This is a forecast that we've been putting on for more than 20 years. And I'm very proud of the work we've done over that period of time. If you look at our track record in forecasting, it's been very good, except for in 2021, when we thought rents would go up by 10% and everybody said we were crazy. And instead rents went up by more than 20% in some parts of Southern California. So we missed that one. And because we believe in transparency, in the following forecast, we reported how wrong we were in the previous forecast. But other than that, we've done rather well. Just a couple of highlights. I remember I got here in 2008. I got to USC in 2008. And in 2009, I insisted, the forecast was being run by a fine woman named Dolores Conway, and she didn't want to report what we were finding, which is that we were predicting that rents would fall. And I said, we got to say that rents are going to fall. And people got mad at us because we said rents were going to fall. And guess what? Rents fell. The reverse of that was, I think the first year I did the forecast was 2012. And in that year, I said we'd see a big recovery in rent, that rents would grow by more than 4% in the following year. And people said, no, you're wrong. We're not going to recover that rapidly. And rents grew by about 6% in the following year. So I don't consider that one a mistake. I think we did pretty well on that one. So check out our track record. I think we've done rather well. So when you're doing your pro forma modeling, you can look at what we do and take what we have to say into account. This event would not happen if it weren't for sponsors. Of course, the leading sponsor is the person for whom the forecast is named, Alan Casden, who gave a generous endowment gift some years ago, which is an important source of the revenue that we use in order to put on this program. But we also have wonderful current sponsors at the benefactor level. We have Related, and I don't know if Gino Canori is here, but, and of course, this is Related's beautiful building, Frank Gehry design building, the Grand up here, the Conrad Hotel. And our silver sponsors, the Heffernan Insurance Brokers, who have been with us as a sponsor for many years now, and the Hutton Companies. And so thank you very much for your sponsorship. We couldn't do it without you. And with that, let me get the program going. This is a transition year. I've been doing this forecast for some years now. I should have looked up. I think it was 2012, the first year, so about 10 years, 11 years. But as I am getting older, I am handing off responsibilities of the Lusk Center to other very capable people. And it pleases me that taking over the Lusk forecast beginning this year is Professor Moussa Diop. Now, I will say that I think it's fair to say there was some collaboration this year in terms of developing the forecast, but Moussa really took the lead on this, and he will be the director of the forecast going forward. We were very fortunate to obtain Moussa. He was at the University of Wisconsin-Madison, which is a place I spent 12 happy years in the 1990s and early aughts. And I was told, and I figured he'd be happy at Wisconsin because I was happy at Wisconsin. I was told by a mutual friend of ours that Moussa wasn't too crazy about the weather in Madison. So I call him up and I say, hey, Moussa, would you be interested in coming over to USC? And he said, yes, he would be. And that phone call led to something we're very happy about, which is him joining us. He's a rare person in that he both has business chops and scholarly chops. He was a senior executive at HSBC before he left the world of business to pursue a PhD at Penn State University. And just this last year, we put him up for tenure, which is a big deal in universities. It basically gives you a job for the rest of your life unless you rob a bank, and even then it's not entirely clear you'll lose your job. but it's really hard to get, and you're reviewed by your peers and from around the country, and people from schools that are as famous as USC. Believe it or not, there are schools as famous as USC. Reviewed his work and came to the unanimous view that, of course, this is a person who merited tenure. So we're very happy he's with us. The other person I need to mention, who has been a really important collaborator on this report for about 3 years now, I think, is Una Jun. Una standing in the back of the room there. Una received her PhD here at USC. I'm proud to say that she was my student when she wrote her dissertation on industrial structure in South Korea, and has just been invaluable in terms of running the models that we need to run in order to produce the forecast you're going to see today. So thank you, Una, for your very hard work. And with that, I'm going to get off the stage and leave it to my colleague, Moussa Diop. Moussa, tell us what's going on.
Thank you. I thought you'd see. All right. Thank you very much, Richard, for these kind words. My name is, as Richard said, is Moussa Diop. I've been here for 5 years. I don't regret at all leaving UW-Madison for USC. It has been great. It's a pleasure to present the forecast this year. So this is the team of researchers who have been involved in the forecast. And Richard mentioned Unha. She has been a critical piece of this research. But in addition to that, also, we did receive excellent support from the LUSC team, namely Marilyn Lewis and Chase McNeil. They helped really putting together the report. So thank you, everybody. Okay. As is a tradition, before we start with the forecast, I just want to give you a very quick update about the economy. Okay. So I have both good and bad news, but like my daughter, I like to start with bad news, with good news. Okay. So the first quarter, the third quarter GDP growth was about 4.9%. I mean, the economy has really been going very strong. And I was just wondering how many of you guys were here last year, and who could have thought that at this time of the year, the economy would be this strong? Could you please raise your hand if you did, make that forecast last year? Anybody? I'm not that surprised. A lot of people thought that the economy would not be doing this well at this time, okay? Many economists didn't get this. Probably the only economist that did get this was probably Paul Krugman. He was quite bullish about the economy, when a lot of people did not. So third quarter, as I said, third quarter economic growth was about 4.9%, which was doubled to the second quarter GDP growth. The economy continues to create a lot of new jobs. Okay, the October jobs numbers are 150,000 new jobs. It was a little bit below expectations because the previous month the economy did create an amazing 336,000 new jobs, which was just amazing. Okay, if you look at unemployment right now, we are sitting almost at a 50-year low unemployment rate. So putting all this together, the economy is still very strong. The US economy is probably one of the strongest economies in the world right now. So that's the good news, right? So which should be great for real estate, of course, okay? The bad news, the economy is not cooling down fast enough. And it's a concern for the Federal Reserve. The consumer price index was at 3.7%. This was at the end of October. I think they did publish some revisions yesterday, slightly below, but not really that much lower. Now, the core CPI, which basically exclude all those volatile items, the core CPI is at 4.1%. This was at the end of October. But right now, it's sitting probably below 4%, a little bit. Okay? And understand that the Federal Reserve tracks the core CPI, okay? Because the core CPI is more indicative of long-term inflation in the economy. So that's what the Federal Reserve is targeting. Now, if you look at inflation from another perspective, from the perspective, let's say, of consumers, okay, because consumers don't necessarily feel the CPI, okay? If you look at the personal consumption expenditure inflation index, which basically takes into consideration the fact that consumers, what they do, they would basically substitute away expensive goods to start buying less expensive goods. Even inflation using that tracker, those indicators, it's about 30 basis points lower than what we see with the CPI. So you're talking about the core PCE at about 3.7%, okay? So that's the challenge we are facing, because the Federal Reserve have increased interest rate many, many times, and interest rates are now standing at a 20-year high. Okay? So, but I think we also need to, which is, of course, very challenging for commercial real estate, any type of commercial real estate. I would say any type of investment, to be honest, okay? But if you look at, but we need to keep this into perspective, though, okay? Because the last 10 years of very low interest rate have been quite unusual, to be honest, okay? If you go back, interest rates are where they were, let's say, in the beginning of the 2008 housing boom, okay? That's where we are right now, okay? The Federal Reserve has been very clear, and the Federal Reserve, and when they met last week, I think this was the November meeting, they decided to leave key interest rate unchanged, okay? The alternative was not to reduce interest rate, but rather to increase interest rate. And a lot of board members have been very forthcoming about the need maybe for another increase in interest rate. We are talking about maybe an additional basis point. Is it going to be in December? Probably not. It depends what kind of inflation numbers they see, but that's not really out of the question that we see another round of interest rate increase. The question is, how restrictive monetary policies will be going forward? The federal government, the Federal Reserve has been very clear. They are steadfast at targeting the 2% inflation. Because we are sitting now at, let's say, 3.4, 3.7. If inflation has to be brought down, let's say, to inflation to 2%, it's going to be quite painful. We may be going through a very challenging period, if that's going to be to happen. Is that going to tip the economy into recession? Who knows? But it's not going to be easy. Okay? The chairman of the Fed has indicated that going forward, monetary policy will be very restrictive. People were really expecting some more softening of monetary policies. It's not about to happen. I think as commercial real estate investors, you need to think about maybe interest rates remaining high for the foreseeable future. Okay, we have been thinking about maybe some lowering of interest rates sometime in 2024, next year. Who knows, maybe the third, fourth quarter, but for now, probably interest rates are going to remain quite high going forward, okay? I think even after 2024, we are not going back to the low interest rate we have experienced, let's say, 5 years ago. It's not gonna happen because the Federal Reserves want to make sure that they have some room to tighten monetary policy if they need to. So now, as if that was not enough, commercial real estate is also facing another challenge, and this challenge is really maturing debt. Investors did take advantage of lower interest rate, of previous very low interest rate. They have refinanced a lot of loans. Some investors did increase leverage, and as a result, we have close to $2.7 trillion of real estate that's coming due, of loans that are coming due for refinancing. And this graph, which we borrow from Greystone, they put together in an excellent report, is basically showing the maturity wave. Well, the highest will be next year, okay? So high interest rates will make the refinancing of this loan quite a challenge. It will be quite challenging. So I'm sure a lot of investors, maybe some of you in this room are already facing this challenge. This may require maybe putting in additional equity or using some mezz financing to fund the gap. But it's going to be quite a challenge for the next couple of years. Okay? Let me just show you a quick simulation I did to see how extensive, how serious this problem could be. So I just take 4 maturing loans, okay? 4 maturing loans that were issued of different vintages, issued in 2020, originated in 2020, 2018, 16, and 13. Okay? Let's assume that those loans were priced at 300 basis above the treasury yield, the 10-year treasury. Okay? Those loans then, when they were originated, the original interest rate was 3.9% for the loan that were originated, let's say, 3 years ago, 5.7% for the loan originated 5 years ago, 5.75% for the one originated 7 years ago, and 6% for the one originated 10 years ago. So now let's make another assumption. Let's assume that basically those loans will still be priced at 300 basis above the treasury rate. And given the treasury rate now standing, I think now it's a little bit lower. When I first did the simulation, it was about 5%, but now it's about, I think, 4.5%. Okay, 4.5%, a little bit more than 4.5%. So you're talking about this loan having to refinance at 7.5% or maybe 8%. Okay? So now, depending on how those loans were amortized, I basically just simulated how much increase in debt service those borrowers will face. Okay? Assuming a 30-year amortization, the loan that was originated in 2020, that loan, the debt service will increase by 55%. Okay? For the one that was originated in 2005, it's going to go up. Debt service will go up by 27%. Okay? The one in 2016, 30%, and in 2013, 22%. So now, assuming again that the debt coverage ratio remains the same, the annual rent growth that would be required in order to refinance these loans at the same DSCR will be astronomical. Okay? For the 3-year loan, you are talking about 16% rent increase over these 3 years. For the loan originated in 2016, 5% annual increase. Okay? In 2017, 4%, and in 2016, 4%, and in 2013, 22%, which is probably achievable. Okay? This just shows you how difficult it will be just based on the cash flow of those properties to refinance at the existing DSCR. Okay? So it even gets a little bit worse if those loans were interest only. Okay? The increase in debt service will be much, 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 much higher. Okay? Again, what we want to highlight here, this is really about a cash flow problem as such, whether or not the cash flow will be enough to sustain the increased debt service. It's not really an LTV issue at all, okay? Because most of those loans, when they were originated, since then, property values have increased substantially. For the loan that were originated 3 years ago, using the RCA CPPI, which is the RCA Commercial Property Price Index, properties backing those loans issued 3 years ago are up 17%. So the LTVs will be fine. So even for the much older loan, you see the property values have been up by 121%. So again, this is a cash flow problem, and whether or not borrowers will be required to really reduce the amount, the loan, to pay down a little the loan so that the DSCR is sufficient for the cash flows to sustain these loans. Okay? I'm showing you that graph again. You know, as I said earlier, the wave will crest in 2024 with about 130 billion loans due for refinancing. These are all multifamily loans. Okay? Of these loans, $80 billion will have maturities of less than 7 years. So $80 billion of these loans will be basically at risk. Okay? Now, what is going to happen? And probably some of you guys have started, if you are in this situation, talking to your banks and to see how to manage basically the refinancing of these loans. So far, we have looked at the TREP data, which is the commercial mortgage-backed securities, loans securitized in the CMBS markets. Multifamily delinquencies have not been going up. They have even slightly lower than they were 10 years ago, or than they were, a year ago. So which indicate that maybe it's just because those loans were very tightly underwritten. Who knows? Okay? What we don't see really is what's happening with banks. But most likely, they will find a way to work this out with property owners. But this definitely will affect how much cash will be available to investors and how well they take care of their properties. Okay? So finally, another issue that investors have to deal with, property owners, is operating expenses. Operating expenses have been going up. This is mainly due to inflation, but also the cost of insurance. The cost of insurance has gone up quite a bit. Okay? And TREP again did a review of commercial properties, backing CMBS loans. This is, they review the 50 largest MSAs, multifamily MSAs, and this is for 2020 and 2022. And they did find that operating expenses did go up anywhere between 6 to 22%. Okay? To put that into context, just remember that in 2022, rent did go up only by 6.2%. Again, NOI will be affected. Okay? So we expect in this forecast that rent will be going up anywhere, let's say, from 2 to 2.5%, just so that you have an idea how much this is going to put pressure on NOI. Okay? So insurance is definitely the largest contributor. Okay? Insurance did go up by 14% on average in these 50 MSAs. So the most affected MSAs, of course, are not, it's not surprising, southern states, but Southern California is also affected. Insurance premiums have been going up, and some insurance companies have decided to freeze their portfolio in Southern California. They're even exploring leaving the market. So again, this will put a lot of pressure on NOI when these, property owners are already dealing with higher debt service. Now, the forecast. Okay? But before I dive into the specific markets, let me just tell you that what we see in the forecast is really very mild rent increase. We see rent increasing anywhere from, let's say, 2% or less than 2% in the Inland Empire to about 4.5% in Orange County. That's what we see in the data. Okay? So now let me go through each market separately. First, Los Angeles. Los Angeles is a great location. A very diversified, a well-diversified economy, nice weather, a lot of diverse communities, but Los Angeles doesn't really build enough. That's the challenge. In the past, maybe this is reversing. Los Angeles did lose population, not just to other states, but also to neighboring counties like the Inland Empire. So we see deliveries going down, being below the average of about 3,000 units per quarter. Okay, that's what Los Angeles has done recently. It's going to go down. Okay, and the issue here, of course, what's causing it, because we have already seen permits being about 13% lower than they were last year, up to the end of October, 13% lower than they were last year. But this is really a conflation of a lot of factors, okay? One of them that we haven't seen yet, and probably it's going to come later, it's the impact of ULI that became effective in April, okay? And we also believe that the impact of high interest rate is not yet reflected in the data. This will come a little bit later, okay? So vacancy on average will remain about 4.5% in Los Angeles County. But of course, you will have a lot of variation, and I will talk about that shortly. Okay? So what do we see rent doing? Rent is going to increase, but about 1.8%. From, let's say, $2,200 to $2,300. This is over the next 2 years. Okay? Our forecast only covers the next 2 years, the next 8 quarters. Okay? So rent will dip a little bit, rent growth will dip a little bit, and then will start increasing. Okay? So now the question you may ask is, what's causing this? What's causing this dip? Okay? So do rent regulations in any way have an effect of, on what's going on in Los Angeles? It definitely have an impact, but as you go further out, the impact will be less pronounced. Let me just put it this way. Rent regulations are kind of baked in our data, and there is no way for us really to extricate it from the data in order to tell you what would happen if those regulations are not in place, okay? But we believe that both the impact of ULA and the fact that interest rate may remain high for quite a while, depressing basically deliveries will affect rent later, will result in rent going up a little bit faster later in LA. Okay? So let me now look at several areas in Los Angeles to just show you how rent growth varies depending on the submarkets. The submarkets that we expect to do quite well are Palmdale, Lancaster, Inglewood, and coastal communities, Beverly Hills. Okay? I think the dynamics of this market is really slightly different. If you look at, for instance, Inglewood and Palmdale, vacancy is quite low. Okay? It seems like the higher rent growth, I'm talking about higher rent growth relative to the 2% that we forecast for those markets. That's what I'm talking about. Okay? I'm not talking about anything close to, let's say, the 4% we will see in some other markets. So in this market, in Palmdale and Inglewood, it's more probably restricted supply. And in the coastal communities, it's probably just demand being so high because people want to live in those areas. Okay? The markets that are not going to do that well is downtown LA, Burbank, and Hollywood, Studio City. Downtown LA, rent is almost going to be at a standstill. Okay? So vacancy right now, what we see in our data, vacancy is close to 8% in downtown LA. It's going to drop, but it's not going to be below 6%. That just makes it very difficult to have any, rent growth in that area. Okay? So Burbank and Hollywood, those areas also rent will be below 2% rent growth for the next couple of years. Next, Orange County. Orange County is definitely one of the strongest economies in the US, okay? And very diversified economy, very wealthy county, okay? But one peculiarity of Orange County is that it doesn't really build housing, okay? It doesn't build a lot of housing. So interestingly, see how low vacancy was, let's say, right during COVID. Okay, vacancy was as low as 2% in Orange County. It's going to pick up a little bit, but it's going to settle at around, let's say, 4%. Nothing really to put any downward pressure on rent. Rent is going to keep increasing in that area. Orange County is the county where we see the highest rent growth in the 5 markets. Orange County will have the highest rent growth. Okay? So Orange County will deliver about, let's say, 650 units per quarter. You're talking about close to maybe 3,000 units per year or so. That's not quite a lot. Okay? That's not a lot. So rent in Orange County will go anywhere from, let's say, average rent from $2,700 to $2,800. Okay? Again, rent growth will be much higher during the first year, and then it's going to drop a little bit. Okay? But at the peak, rent growth will be close to 6% in Orange County. That's next year. And then it's going to tail off a little bit. Okay? So again, even in Orange County, you see a lot of diversity. Okay? The market that's going to do quite well is Anaheim market. Okay? Rent growth there will be above 4.5% for the next 2 years. And it will be very stable, above 4.5% in the next 2 years. Okay? The other markets also will do quite well. But in those other markets, what you will see is that rent will be very high. Rent growth will be very high the first year, and then it's going to dip. Okay? You will see in Irvine, for instance, and coastal communities, rent will go up, let's say, for the first year to about 5%. Then it's going to dip below 3%. but still much larger than what you see in LA. So the Inland Empire next. Okay? The Inland Empire has been propelled, the economy of the Inland Empire has really been propelled by industrial during COVID, the growth in industrial during COVID, and the fact that also housing was much more affordable in that area than in LA, for instance. And we did gain a lot of population from LA, Orange County, and San Diego County. Okay? The Inland Empire will see about close to 450 units being built every quarter. Okay? So vacancy right now is close to 6%. Okay? The Inland Empire did become a lot more expensive because of the exponential rent increase during COVID. And vacancy will start slowly to decline, but it will remain, let's say, somewhere between 5.5 to 6%, closer to 6%. So rent increase will be, the Inland Empire will experience the lowest rent increase. That's what we see. The rent increase will be much lower in the Inland Empire. Okay? The rent increase there will be about, the rent growth will be about 1.2%, 1.5% to 1.6%. So interestingly enough, rent growth right now is almost 0% in the Inland Empire, and we forecast rent to even go negative, rent growth to be negative during the next 3 quarters before picking up a little bit, okay, after. Okay? We also see a lot of heterogeneity in the Inland Empire. Okay? Riverside County and Rancho Cucamonga will be the highest, the best performance in terms of rent growth. Rent will be much higher there. But again, not the kind of rent growth you see in Orange County. Okay? You're talking about just slightly above 2% annually. Okay? So the areas that are not going to do that well, the submarkets are going to be Palm Springs and outlying San Bernardino. I mean, rent will be basically stable and even slightly decreasing in Palm Springs, Indio, okay, and outlying San Bernardino. San Diego County, very similar to Orange County. A lot of similarities between San Diego County and Orange County. They have similar economies, similar size, and also they share the fact that they don't really build much, okay? So Orange County will, San Diego County will deliver the same number of units as Orange County, but it's going to experience higher vacancies than Orange County, a little bit higher vacancies than Orange County. So rent growth in San Diego will be right in the middle of the pack. Okay, it will be not as high, about 2% over the next, a little bit slightly over 2% over the next couple of years. Again, that's a very expensive market, and again, a market that did experience significant rent growth during the pandemic, but rent will stabilize in that market. A lot of heterogeneity again, a lot of variation in that market. The markets that are going to do well are Chula Vista and Inland San Diego. Surprisingly, and I still don't know why, okay, city of San Diego Coastal is not increasing by much. We only see about 1%, okay? I really don't know exactly what's causing it, okay? Compared to Inland San Diego, for instance, where rent is going to grow by close to 3%, okay? So the last one, which is a surprise to us, is Ventura County. It's going to be the second largest, it's going to experience the second largest rent growth after Orange County, okay? But of course, this is a very peculiar market because Ventura County doesn't add, housing at all. I mean, we see close to maybe 110 units being added every quarter. You're talking about 400 units per year. That's not much at all. And vacancy right now has been quite high, which maybe explains why you didn't see that much, more housing being added. But vacancy is really sitting at below 4%. It's going to go up a little bit, up to, let's say, 4.6%. But rent growth will be much higher in that market, as I said. Rent will go up, let's say, from $2,500 to about $2,400 over the next 2 years. Okay? And again, this is going to be the second largest rent increase that we see, okay, after Orange County. okay, after Orange County, and then Los Angeles County, San Diego County, then Los Angeles County, and the Inland Empire. That's what we see. Okay? So in Ventura County also you see variations geographically. Camarillo and Ventura County, Oxnard will be the best performers in those markets. Okay? And rent increase there will be close to 4%, okay, over the next 2 years. Okay? The markets that's not going to do that well are Simi Valley and Ventura County. Those markets will not do that well. Now, to summarize, okay? So, as I said earlier, we expect very mild rent growth over the next 2 years, okay? And this is nothing similar to what we experienced during the pandemic. It makes we talked about it, Richard, our forecast this year a little bit boring because it's very, except maybe for what's happening in Orange County and in Ventura County, the rest of the markets are very similar, okay? And the high interest rate environment, if it remains, if it lasts, will definitely, add more steam to rent growth, no doubt about it, okay? But we don't think it's there yet. We think that's something that's coming maybe in the next 18 to 24 months, okay? Los Angeles, for instance, we are predicting close to 2% rent increase. I won't be surprised if it's much higher than that if they remove some of the regulations, okay? So higher financing costs and operating expenses will definitely put a lot of pressure on NOI for a lot of property owners, okay? Property owners have to really start thinking about, even if your loan is not maturing, you need to start thinking about stashing cash somewhere, okay, if you can, and just prepare for it. But also just start talking to your lenders, okay? You need to be a little bit more proactive. Again, it's a good sign that we don't see vacancies or delinquencies going up in the TREP data. And I'm sure that banks in general will be more willing to accommodate, to really, will be more flexible, let me put it that way, than, CMBS lenders. Okay? And finally, if you want really, this is specific to Los Angeles County, but probably Orange County, it applies also to Orange County and San Diego County. In order to really improve housing affordability, they will definitely need to build more. It doesn't seem like, Los Angeles County definitely is not building more, and we are concerned about the impact of higher interest rate on, development in general. So don't be surprised if, for instance, the city of LA decides to just maintain some of these regulations because of the impact of higher interest rate and the fact that it may lead to much higher rent if those regulations are removed. I wouldn't be surprised. That's all I have for you. Thank you very much for your attention. Thank you.